So the strategy that I deploy, we look at different asset classes and we reinvest our capital only into one asset at a time.
Chris, what is the number one secret to building wealth using asset revesting?
Well, yeah, to bring it down from a high level. So pretty much everyone does one or two of the most popular types of trading and investing methods. They either do one, they do the buy and hold. You do your stock bond portfolio split, you park it, you leave it forever. That is a very risky way, especially if you're in the later stages. If you're close to retirement or retired, it is a great way to have very low average income because you're going to have some assets that are doing well, but other ones that are tanking. And then when you blend those together, you end up with a really average return. And that's what the average buy and hold has. You never see a buy and hold investor retire 20 or 30 years younger, sooner. It takes time to make money that way. And it is a roller coaster ride. You'll go decades sometimes without really generating any real return if we have a multi-year correction or something like that. The other extreme are the active traders. And there are numerous studies across North America, Japan, Taiwan, Brazil, that show that if you're an active trader and you trade your money for more than 300 days, even during a bull market, 97% of active traders lose money. Now, I've been in the trading newsletter industry for over 25 years, and it is a rotating door. It is definitely difficult. People are struggling with their emotions. And so either one of those is very dangerous. They're high risk, and you either don't make much money, it takes you forever, or you lose it trying to make high returns. And so what asset revesting is kind of right in the middle. So the strategy that I deploy, we look at different asset classes and we reinvest our capital only into one asset at a time. So, I mean, there's a lot of things we could crack into here, but long story short is the stock market is one asset class. It doesn't matter if you own 400 stocks, you have ETFs in all kinds of sectors. If you own a stock, it's really just one asset class. The stock market is one asset. Bonds is another asset. Real estate is another. Startup. There's a lot of different types of assets. But what we do, or what I focus on here, is if the stock market is favorable, then we want to put our money into the stock market. If it's not favorable, we want to move to a different asset that is going to go up and benefit while the stock market is out of favor. And I do this with what I call an asset hierarchy. And so at the top of our hierarchy is always going to be the most volatile asset. Now, anyone can create an asset strategy around the assets that you like. There's people who are in the precious metals and currencies or cryptos or whatever. The one that I stick with, my asset hierarchy, for example, is the stock indexes. US stock indexes are the top. They're the most volatile, the most stable still. They have lots of liquidity. And if they're in favor, we want our money to be in there because we can make some good returns very quickly. But if the stock market's not favorable, then we want to go and look at treasury bonds. And if bonds aren't favorable, then we actually go and we look at the US dollar index. And if the dollar index isn't favorable, we move down to literally just an interest earning, more or less sitting on the sidelines in cash, collecting interest each day while we wait for an asset to give us a new signal. And what's really important about this is as the stock market goes out of favor and we move down that hierarchy, each asset class is a slower and slower moving asset. So typically, as the markets get more out of control, we're moving lower on that hierarchy to slower moving assets. And so our money is being a lot more safe and has a lot less volatility when everything else is going haywire. So it's really important to move away from volatility. And most people do the exact opposite. When there's a lot of volatility, prices rallying or falling, they tend to move into options. They tend to use leveraged ETFs and try and take advantage of picking bottoms or trying to profit from falling prices. And it's really the wrong direction you want to go. When things are volatile, you want to step back, let the markets reset. And then once a new trend is in place by following the price action, then we move into whichever asset has kind of got the strongest trend on our hierarchy. That's kind of it in a nutshell.
Okay, that's amazing. By the way, it means I need to get the book because that was a big nutshell, but it was a good nutshell.